We appreciate everyone joining here today. It appears that we have an exceptional turnout, and we hope you find it all very informative. My name is John Gilbert, and I co-lead the Alliant M&A practice. For those of you who don't know Alliant is one of the largest national brokers. We have over 4,000 colleagues in 100 cities nationwide and are growing at a very rapid pace. Alliant M&A is the recognized leader in the M&A community, currently serving over 150 private equity firms nationally. We continue to grow with top industry talent. Very excited for you to hear from the colleagues on the call today, as well as our friends at Alston and Bird. With that, I'm going to turn it over to Dan Schoenberg to talk a little bit more about our transactional risk group and the topics for today.
Thank you, John. Hi, everybody. It's Dan Schoenberg from Alliant, New York. I co-lead the Alliant M&A practice with John, and I'm a transaction liability specialist. And that's obviously the topic of today. For today, thanks everyone for joining. We're going to take three products in the transaction liability space in order. The first one is representations and warranties insurance. And our two speakers on reps and warranties insurance are Larry Shapiro from Alliant, as well as Mitchell Griffith, a corporate partner with Alston and Bird Dallas, who specializes in M&A transactions for the firm's private equity clients. Next, we're going to turn over to tax insurance, which is a product that's growing very, very quickly. And our group of tax attorney brokers have placed over $25 billion of tax insurance. Austin Cahill is going to lead that discussion along with Scott Hardy. Austin recently joined us, and he is a senior tax attorney as well as an experienced tax broker. Scott Hardy is a tax partner at Alston and Bird's Atlanta office. After we go through tax insurance, Jason Goldie from Alliant, New York, is going to introduce our litigation insurance products, which we believe is sort of going to be the third spoke of the transaction liability wheel. Jason is a senior commercial litigator with stints at two of the large law firms before joining us in June. So with that, I'm going to turn it over to Larry and Mitchell for reps and warranties insurance.
Well, thanks, Dan. This is Larry Shapiro, and thanks for the great introduction. I'm excited to participate on the webcast today and to be presenting with my co-host, Mitchell Griffith, for the representations and warranties section of the webcast. When trying to understand the full scope of coverage that is available to prospective insureds, a helpful way to sort of wrap your head around what type of insurance to potentially pursue is determining whether or not you're looking at an unforeseen loss, an unknown exposure, or if you are instead addressing an identified or potentially known risk. When we're focused on representations and warranties insurance, we are focusing on that first bucket of potential exposure, which would be unknown exposure or unforeseen loss. That is covered in slide 4 to some degree. And so to the extent that folks listening would prefer to refer to a slide, that would be one to look at for reference. So discussing known and unknown risk, Mitchell, you and I were discussing this in preparation for this webcast. A useful way to look at this is that representations and warranties insurance, it evolved as a deal facilitation tool, but it's primarily used to either supplement or replace seller indemnity. And to fully appreciate the known versus unknown relationship that we were discussing earlier, you can contrast it against a traditional seller indemnity. So if you were taking a more traditional transaction structure where you would have a seller that was knowingly giving representations about a target, and a buyer involved in the transaction with that seller would be relying upon the accuracy of those representations in order to complete the acquisition. The seller that was providing the reps was providing an indemnity and standing behind and negotiating those very same reps. So you've got a sort of full chain of knowledge, if you will, between the party that's giving the reps and the party that's standing behind those reps in the event that there is ever a claim that the reps were breached. Now, if you introduce transactional insurance, we start to see how that dynamic changes, because you still have a seller that's knowingly giving reps about a target, but they're no longer meaningfully standing behind the reps. Rather, you've got a third-party insurance company who previously had no knowledge about a target prior to the transaction, but that insurer is being asked to stand behind the risk that there are any unknown breaches of the representations that are given. So in order for them to assume a coverage position, we have to find a way to bridge the knowledge gap. And we do so by presenting the insurer, because they're no longer the seller that knowingly gave those reps, but now they need to have the knowledge to bridge the knowledge gap. So we give them access to buyer diligence, and that becomes the underwriting exercise to get the insurer who you're asking to stand behind the reps to get comfortable enough that there is no unknown breach of the reps by virtue of the diligence that the buyer has conducted. That is just a brief outline of the way that representations and warranties insurance is used to cover off unknown breaches of the reps in a transaction. Now, Mitchell, I might be inclined to turn it over to you to talk a little bit more about how representations and warranties insurance functions, and then perhaps later on I could lay out some trends that we've been observing over the course of the past 12 months and maybe our expectations for the marketplace in the future.
Sure. Thanks very much, Larry. So, rep and warranty insurance is the type of transactional insurance that has caught on the quickest and is the most, widely used. So I'm not going to belabor any of these points, but it's often helpful to sort of step back and appreciate some of the key benefits of the product and how it operates. So in a traditional deal, whether you've got a seller indemnity, you will oftentimes or almost always have some sort of holdback that's a pretty significant amount of the purchase price. Usually 10 to 20% of the purchase price is held back for a period ranging from usually 12 to 24 months. That's one of the key benefits of having rep and warranty insurance, is that you can reduce that amount of money that's held back dramatically. When rep and warranty insurance was first starting out, that 10 to 20% was brought down to around 1%, and now you're seeing that amount closer to 0.5% or oftentimes the minority of cases, but increasingly accepted, is you're seeing a seller with zero holdback and sort of no post-closing obligations for rep and warranty breaches. That obviously presents, a number of benefits for sellers, and that's one of the reasons why it has taken off as quickly as it has. So I'll move to the next slide here, highlighting the different benefits of rep and warranty insurance. It was adopted and caught on primarily with private equity sellers first, and then other types of sellers have started to utilize the product. But of utmost importance to private equity sellers is that the funds that are selling these portfolio companies want a clean exit, and they want it to happen at closing or as close to closing as they can. So the benefits of having under 1% of the purchase price sort of held up at closing is obviously hugely important to them. Then you've got the added benefits of sellers and buyers not needing to spend excessive amounts of time belaboring the negotiation on the reps and warranties themselves, because they have, less money at stake. That does introduce then how the insurer, how are they going to get comfortable with the fact that the reps don't just say, well, we have no liabilities whatsoever, and if there ever is any liability, you can just recover under the policy. So the insurers do expect that the buyers are doing a fulsome diligence process, but it still allows the buyer and seller to not spend excessive amounts of time belaboring that negotiation process, which then allows the agreement to reach signing quicker and allows the process to close faster. You also save money on just lawyer fees by not having to spend as much time negotiating the reps and warranties or the indemnification mechanics, because that can be a little bit more streamlined when we're talking about smaller amounts of money. The other sort of primary benefit of rep and warranty insurance is oftentimes the buyer and the knowledge parties that are really sort of being relied upon to make those reps are aligned post-closing. If you're buying a business and you're retaining management and needing them to operate that business post-closing, it can be very awkward if there's an indemnification claim and you have to sort of figure out who knew what when and make
various allegations about reps being breached. So having a third party involved can sort of eliminate some of that awkwardness when you're needing to continue to operate the business post-closing. Some of the other benefits is just the nature of rep and warranty insurance policies themselves. It's pretty typical for the policies to last 3 to 6 years, depending on, there could be earlier cutoffs depending on the particular rep. Whereas, as I mentioned earlier, in a standard seller indemnity, no seller wants to have a significant portion of the proceeds tied up for that long of a period of time. So you're talking more 12, 18, 24 months. So that gives the buyer more protection there. You get a broader scope of reps and warranties if you're not spending as much time, nitpicking those actual reps. It eliminates the credit risk of a seller post-closing. If a company is selling all of its assets, or you don't have to worry that you're not going to be able to collect on that because you've got a reputable insurance provider that's standing behind the reps and warranties.
Sorry to interrupt. I had a question for you as you're going through the relative benefits. For your clients that are using reps and warranties insurance, have they mentioned to you what they find the primary interest to be? Are there some of these advantages that compel some of your clients more so than others?
Equally concerned, I would say, with getting to signing and closing faster without having to spend a significant amount of time negotiating the reps. And then also the clean walk away, right, and not having 10 to 20% of the proceeds. And I think those things both go hand in hand. And yes, that is sort of private equity originally drove that, but that sort of seems to be across the board two primary motivations that sort of, those motivations are always going to be there no matter who the seller is. It's not so much that, you get the better credit risk, but it's also just the fact that you can present an attractive, option to the seller, and then from a buyer perspective, they'll be more interested in your bid if you are distinguishing yourself by offering rep and warranty insurance instead of requiring a standard seller indemnity.
Definitely seen that trend with our clients as well. Thank you.
Right. There's a slide in here that sort of breaks down a $200 million enterprise value business and how that would be allocated in a standard deal versus a rep and warranty insurance. And so you'll note that for the very first amount of losses that occur, that's either going to be borne by the buyer or most often split first by the buyer, then the seller, but then sort of that next huge range. And the vast majority of losses because of breaches of reps and warranties are either going to be under that retention amount or within that next band of losses that have to do with, that are covered by the rep and warranty insurance policy. And so that's the benefit of it, is if you're talking about a $100 million loss in a $200 million business, rep and warranty insurance is going to be, nice to have, but you've got bigger problems there. But in most deals, when you've got a significant but not catastrophic loss, you're going to be squarely within that amount of loss that's going to be covered by the rep and warranty insurance policy. So it just gives the buyer a lot of comfort when they buy a business. Important to note is, and the policy exclusions, a lot of these are going to be deal specific. There's sort of a market for what's standard exclusions include. That's working capital adjustments, purchase price adjustments, known liabilities. Larry was talking about earlier the difference between unforeseen losses because of breaches and known liabilities. And then there's just a whole host of specific loss types that an insurer may or may not be comfortable insuring against. And they can get comfortable, oftentimes if the insurer can be convinced that the buyer has done sufficient diligence. If there's overseas operations and the buyer hasn't engaged specific counsel, then in that jurisdiction, then they're probably going to exclude any losses from that jurisdiction. But those are really deal specific that can be negotiated. I'll just hit the claims process before I'll turn it over to Larry to discuss some market trends. But, it's also a smoother claims process than if you're dealing with a seller. So when you become aware of the third-party claim or the potential breach, you notify the insurer, and the insurer is going to investigate the claim, and there's going to be a back and forth process, just as there would be with a typical seller indemnity, and then the insurer will sort of make a decision and pay on the claim as they ultimately determine or is sort of agreed among the parties. But there's obviously some risk there, and there's going to be probably disagreements about the scope of the loss, and that's just sort of natural. But my clients have found that this process is significantly smoother and easier than having to sort of fight over the scope of loss with a seller. So that's one of the other huge benefits from the buyer's perspective.
Yeah, I think that's that's certainly a benefit that is worth highlighting. Oftentimes, it can be a hard thing. When you're outside of a conflict, you don't necessarily want to foresee, especially when you're thinking about pursuing a transaction with a seller. You don't want to foresee there being a conflict, and so I think the notion of using insurance sometimes can be challenging because you're not going against the party that you're going against this insurance company with whom you may or may not have a commercial relationship with. But I think that our client's experience has been that, the process is in some respects not altogether that different from pursuing a seller. It's not that you're going to be paid, the very same day that you put the claim in, but at the same time, we've been able to move claims processes pretty responsibly forward, facilitating the adequate and necessary information flow, but getting to the right result. And I think that is what people are buying, is they're buying a promise. They're buying a promise that here lasts about 6 years potentially. And, you've got commercial parties that are each incentivized to get to the right result.
So that was all I had on the sort of mechanics of the rep and warranty insurance policy. So if you want to address some of the recent market trends and where this product may be headed, that'd be great.
Sure, I'd be happy to. I think, making reference to some of the exclusions that you were speaking about earlier, I think that the situation with respect to exclusions from coverage is an evolving one. I think as this year has progressed, we've, as we tend to track market trends, a lot of it should understandably focus on the scope of coverage. And, towards the beginning of the year in, early mid-spring, and as we proceeded into the summer, we saw a lot of insurers, and you may have seen this in your client base as well, Mitchell, trying to get comfortable with the new risk environment that was created by the pandemic. We saw insurers grappling with COVID-related losses and PPP loan exposure, even increases in potential data security and cyber breach risks, given the obviously more robust work from home environment. So I think over time, what we saw is a number of insurers took a pretty aggressive focus on COVID-related loss, although some of them were able to sort of walk it back to some degree and tailor their exclusions to be more appropriately in line with only those exposures that their customers or suppliers that were materially and adversely impacted by the pandemic had experienced. So we've watched that sort of expand and contract a little bit over the course of these last 8-9 months. In particular, as we have successive waves of the pandemic, we've seen the exclusions either loosen up or start to take hold again, and we have, of course, taken a wait and see attitude, except that we'll push on insurers to obviously get as aggressive as they can with respect to the coverage, to the extent that it makes sense given the risk. From a pricing perspective, I think this is something, and Mitchell, I'd be curious to see what your experience has been looking at it through your client's eyes, because obviously I think that's one of the areas in where the pricing really hits home. Over the past 5, 6, 7 years, we've seen the direction of pricing start from a relatively higher rate online perspective, which is just the price of the coverage as a percentage of the limits purchased. And it has steadily decreased and gotten much more buyer friendly. And that trend had continued throughout, the past 5-year period, up to about a year ago. And then I think maybe early mid-spring last year, we started to see, to a degree, the pricing certainly stopped declining. And then I think a few markets here and there had started to increase their pricing relatively notably. And as the deals proceeded into the summer and then certainly into the fourth quarter, we saw pricing move up on a relatively noticeable perspective. Some insurers, I think, as little as a 20 to 30 basis point increase. In other insurers, I would say their pricing on average might have ticked up about 30, 40, even 50 basis points. So a material change. I'm not sure if you noticed that through your own practice, Mitchell, but certainly.
Yeah, I would say that was definitely something that we noticed. I have to feel like that was probably a sort of necessary market correction, and that I think sellers were getting very aggressive on how broad of the scope of the reps and warranties they were giving. And so I think you were seeing the insurer sort of price that into, what they were willing to provide.
Yeah, it certainly is interesting because I think those 2 points have gone hand in hand, especially over the course of the last year. We started to see a number of insurers having significantly more commentary based upon the language of the reps and the agreements that they were presented. I think in years past, whether it was a reflection of just a very insured-friendly market or whether it's more recently a reflection of some more aggressive drafts of the reps that are being presented for insurance, I would say over the last 6 months we saw more comments than we had previously been used to, and that I think arose together with a higher pricing in the market. In addition, I think at the end of the year, it was just an outrageously busy marketplace. I think in December we saw the busiest marketplace for transactional insurance that we've seen on record to date. Somewhere between around 300 and 400 new deal submissions made it into the market, and that was certainly a high water mark. If you take a look at it in terms of the number of policies that insurers actually underwrote, while it doesn't necessarily indicate the number of deals that were insured, we've got insurers that each did 30, 40, 50, 60 policies placed in the month. One insurer reported about 125 policies placed. So certainly a robust and busy marketplace. And I think as a result of that, some insurers may have even used pricing as a proxy to help them manage deal flow a little bit. And so what I think that means for clients as we start to look at the market for 2021 is that some of that pricing, which was, creeping up towards a high water mark, is likely going to come down a little bit more, maybe not all the way to where it was a year ago today, but certainly I think it should be retreating a bit more from the year end where pricing was at the highest market it was at. So from a trends perspective, certainly we've talked about scope of coverage and on pricing. I think in terms of trends that we might be looking forward to, obviously tech and healthcare sectors have been incredibly robust from a deal activity perspective, and so we would expect that trend to continue. In terms of some of the challenges that we've seen in the market, we've noticed a bunch with respect to deal structures. I think that we've seen some evolving deal structures out there, including using contingent consideration and earnouts to help manage some of the uncertainties revolving around valuation. And a trick for us is going to be making sure that we can use transactional insurance to adequately respond to those structures. Another challenge that we might be seeing is going back to something that we discussed earlier from the perspective of cyber coverage. With the increased risk exposure out there, in particular, I know that there's been a market increase in ransomware attacks. So taking a look at the cyber risk profile that may be present at targets that either didn't have a high risk profile before or they did but is now heightened, making sure that targets have adequate underlying cyber coverage in place, understanding that there are some challenges in the cyber market as well. And I would say will be a trend that we can look forward to having to continually navigate in the upcoming year. So Mitchell, with that, I think that caps off where we are in terms of the current market and trends. And unless we've got further to add with respect to reps and warranties insurance, I'd be inclined to turn it over to Austin Cahill to introduce the tax section.
Thank you very much, Larry. Thank you very much, Mitchell. And hi, everybody. You've got Austin Cahill here from Alliant, as well as Scott Hardy from Alston and Bird. And today we're going to be talking to you guys a little bit about tax insurance at a high level, and then also additionally some maybe market trends that we're seeing in tax insurance and going into 2021. So, with that said, tax insurance at its highest level is exactly that. You know, an A-rated insurer, such as an AIG or a Berkshire Hathaway, or maybe a specialist underwriter backed by Lloyd's, like an Ethos or a Euclid, will indemnify an insured for any loss arising out of a challenge in the event that a tax position fails to qualify for its intended tax treatment. So almost any time that you have a tax risk that you're concerned about, you should be thinking, hey, can I insure this? Where do we see tax insurance the most? You know, we see our clients come to us about tax insurance as both buyers or sellers in M&A transactions, or independent of any transaction at all. Most commonly by buyers after they've received a tax DD report that's identified a tax position as suspect or, you know, a potential issue. Or we've also seen it by sophisticated sellers ahead of a sale or an auction process, typically when they know that they've got a tax issue that's likely to be identified by a buyer during their due diligence period. Tax insurance can replace an indemnity, escrow, or avoid a price chip for a one-off premium that will typically cost between 2 to 4% of the estimated tax liability. I think it's important to note that it costs nothing to get a policy quoted. So in the seller example, you know, that I just gave, you don't actually need to disclose to the buyer that you've gone out and explored tax insurance. And with it, if the issue is identified, you can eliminate negotiations around what to do because you know exactly how much it will cost to take the risk completely off the table. Off transactions, we're increasingly seeing the product being used, and we have a few examples of that. Now, we can't insure every risk under the sun. You know, there has to be a meritorious defense to the identified position. And Scott, you know, being that you support roughly half of the tax insurers in the market, you know, what kind of comfort do you usually need to see as a threshold to getting something insured? And how do you see that affecting pricing? You know, what do you need in order to get a policy?
Yeah, thanks, Austin. You know, you get we've reviewed probably in 2020 70 to 80 different risks, and so you see a variety of opinions or memos that will describe what the risk is and the comfort level. At a very high level, I would say the more robust the analysis, the better, obviously, for the insurer and the better for the pricing. That's the same for the comfort level as well, that if the comfort level is at a should level, that's preferable to a more likely than not, but a more likely than not is a comfort level that's insurable. So you want to see, or we like to see, you know, strong analysis supported with, you know, cites, case law, whatever it may be, and a comfort level that, you know, appears reasonable based on the facts and the law that's being applied. We have seen submissions where really there is no supporting analysis. You might get some documents to review, but there really isn't a memo that goes along with it. Those are much harder to insure. Puts more work on us to actually do the work that the insured probably should do. It does happen. It's probably the minority of submissions that we see. But I think if you want to get the best possible pricing, then you want to submit a fairly robust memo with a strong level of comfort. Like on the more likely than not side, if a insured comes to a more likely than not level of comfort, I think what you'll look for is what's the range of more likely than not. So some clients will say, or insurers will say, well, yeah, we know that this might be a 51% or it might be it's a 60%. Where do you kind of fall in that range? And that's where I think a strong analysis can really support a good submission, and where a weak analysis might lead you to a kind of almost a 50-50 determination and would certainly affect your pricing.
That makes sense. So it's almost like a more likely than not can get you through the door, but it'll really depend on the underlying, robust analysis provided by an independent tax advisor.
Mm-hmm. Yeah, and we've gone back and said, well, you know, we think this looks insurable, but you know, could you maybe update the memo a bit or maybe address a couple of questions? And then we've gotten back much more thorough memos that have been, you know, it has definitely benefited the client on the pricing side and even getting a risk insured. Sometimes it may be an issue of insurability or not. So I do think on the front end doing that work is helpful.
That makes a lot of sense, and I think I very much agree with you. I think from a broking perspective, it really going out with your best foot forward the first time you submit to the market will usually end up with, the best results. So kind of something important to keep in mind. Moving on to, the next slide here, what is the scope of tax insurance? So tax insurance is typically designed to cover claims within the applicable statute of limitations, most commonly 7 years, because the federal income of statute of limitations for a material understatement of income is 6 years. But policies can extend out to 10 and more recently all the way up to 15 years, which is particularly important for carbon capture 45Q credit risks that we're seeing coming across the line. The product will not only cover any additional taxes owed, but any interest, fines, penalties, and gross up to the extent the insurance proceeds themselves are taxable. Product will also cover reasonable defense costs or attorney's fees, sometimes above a small retention around $100K, sometimes a little bit larger, sometimes no retention at all. Scott, in terms of jurisdiction, is there anywhere that you see that tax insurance can or can't play a role?
From a jurisdiction, what we mostly see is certainly federal tax issues, U.S. federal tax issues. We've started to see more issues with the states, particularly around transfer taxes and some planning that's gone on there. Even some tax credits, state-related tax credits, for example, low-income housing tax credits. On the international side, we will not review risk for Central or South America, but it might come across our desk. And we would be asked a question about contacts there and what we think of a jurisdiction and our experience there. In some jurisdictions, we had more experience than others. So we have seen risk in Puerto Rico, Mexico, South America, which would, present some challenges. But at least in terms of the U.S., they're really kind of the sky's the limit. We've seen it in the states and in localities. So I don't think you really have too many limitations there.
That makes a lot of sense. And in terms of Europe, I think most European risks are insurable so long as they're in an OECD member jurisdiction. In Asia, it'll usually be the most established jurisdictions that we can get coverage in. But I would say that, as of now, tax insurance is really spurned throughout the globe. And whether it's in the U.S. or whether it's in Europe, tax insurance is an opportunity there. I think one other thing just to add is just because a risk has been discovered doesn't mean that insurance isn't a candidate. It just means that the threshold and the level of comfort needs to be a little bit higher, and pricing will likely materially increase. For example, we're insuring a live audit risk right now in the U.S. and also in Canada. If you've got a risk that's been identified by a taxing authority, I would say you need a good should to get in the door if you're under live audit. And additionally, contest costs won't be covered in the event that you've got a live audit.
So I would just add to that I agree. You definitely should not rule it out just because something is under audit. There still may be opportunities for insurance, but like you said, comfort level will definitely need to be higher, and a lot more analysis on the submission will be needed.
Understood. So this next slide is just to identify that there's a bunch of different types of tax insurance out there. You can insure identified risk through tax liability insurance, unidentified risk through tax and return insurance. If you're wrapping up a fund, if you're liquidating, we can cover both the contractual indemnities in the, if there's any indemnities remaining within any, purchase or sale agreements still existing, as well as any structure risk when you're wrapping up the fund. Tax is a part of reps and warranties insurance, and also part of contingent risk insurance if you have a trigger that may have a tax loss, such as you donate the facade of a building and there's a fire, you get tax credits for the donation, but if the fire comes, you get a recapture. We can actually wrap insurance policies around there. But kind of moving on to the next slide here, what types of risks can you insure? I would say the most common risks insured are risks that result in a large amount of tax being owed based on qualification of a structure, such as S-corp validity, REIT qualification, spin or split off, not constituting a device or not qualifying under 355. But we are increasingly seeing the product used for a various and wide range of risks, including off transactions, kind of splitting it up into between portcos and funds. A few things that I've seen recently at the portco level, maybe independent contractor versus employees. We had someone come to us with a risk recently where they were buying a a good amount of property, and they wanted to make sure that the value was adequately assigned to each asset class to guarantee proper depreciation. On the structure side, like I mentioned, we see S-corps or REITs, and oftentimes in the context of maybe you've identified a small foot fault that you've stepped into and you don't have a time to go out for a PLR. So you go out and get the tax insurance because the process is much quicker. And at the fund level, we see things insured like treaty qualification or withholding, insuring substance. Something I've seen recently is someone trying to insure around the 3-year holding period on the new carried interest rules, on secondary transactions under the Tax Cuts and Jobs Act. Dispositions of U.S. partnerships by foreign partners are now subject to tax on their effectively connected income. There's a very aggressive withholding regime there that for the buyer, if it's determined that the disposition by the seller will result in ECI, you can't, you have to withhold a certain amount of the purchase price, sometimes up to 100% if you can't certify the liabilities. And on the sell side, on secondary transactions, you're selling a bunch of partnerships and you're supposed to be able to calculate for each one of them the amount of effectively connected income. And it's very difficult to do on secondary transactions, specifically when you have a lot of downstream partnerships. So different methodologies on how to calculate that amount, something that we're seeing. And last thing worth bringing up is NOL carrybacks. Under the CARES Act, you can now carry any NOLs generated from 18 to 20 up back through 5 years. We can ensure the availability of the carryback, the availability of the losses themselves, the valuation of the losses, and actually uniquely any potential offset. So if you're bringing back into a year and there's some other tax issue in that year, the IRS is going to try to ping you. They don't want to give you your money back. So the product can actually be used to ensure the refund claim in its whole, not in just its part. Scott, what else are you seeing in terms of what types of tax risks you're insuring?
Yeah, I agree with everything you said. I think historically there have been very common risks that you see a lot of, such as REIT qualification, renewables, so investment tax credits, production tax credits, S-corp risks are all those kind of 3 buckets I think are traditionally very common risks that are insured in the market, a lot of comfort level around them. What I've been encouraged by in the last couple of years is the variety of risks that I've seen. And so in a sense, I think the penetration has been good because market participants are thinking more broadly, and I think rightfully so, about the product. And so other areas that I've seen are certainly, restructurings. You mentioned 355 spends. Definitely have seen those. Partnership issues have been more prevalent. We've seen that on capital shifts in partnerships, seen bankruptcy-related issues, particularly around consolidated groups and excess loss accounts, even going into 409A issues, Section 83 issues related to compensation. And on the S-corp side, and we've seen kind of qualification of ESOPs even, seen that fairly recently. So to the extent an S-corp as an ESOP shareholder, that can be an issue because there's a lot of footfalls around ESOPs. Buyers get nervous around that. So it's just been a real host. You mentioned the extended kind of going beyond 7 years. We've seen R&D credit risk that has gone beyond 7 years, actually longer than 10 years. So, I think I would encourage participants to think broadly about this and to the extent of if you have a tax issue, maybe not, but insurance might be a solution for it, particularly in a transaction. And I wouldn't be limited by the nature of the issue.
I think that makes a lot of sense. And I know we're running a little bit short on time here, so I'm going to jump ahead to process. In terms of process, as I alluded to before, you can really get a tax insurance policy placed rather quickly. I would say from the time that you bring us the risk, so long as the diligence is in order and able to be submitted to the market, takes between 5 to 10 business days. And how that will work is you'll come to us with a risk. We'll prepare a submission to the market on your behalf, go out and negotiate the best pricing that we can have available, prepare for you guys a report that will lay out, what the insurer's coverage is looking like, if there's any material exclusion, pricing, retention, and the like, and we'll provide you that packet of report once you, determine to go with a selected insurer. The insurer will do a bit more digging with the likes of Scott and their underwriting counsel to really flesh out any additional questions they have about the risk. Simultaneously, we will be negotiating the policy language itself. Alliant has best-in-class policy wording with most, if not all, of the insurers out there, so the process is a relatively quick and streamlined one, and we can probably put a policy together for you between 5 and 10 business days. Now, moving on to, most importantly here, the market trends, I would say we've seen, quite a few new entrants. There's currently 13 tax insurers in the market who underwrite U.S. risks, a bit less for the rest of North and South America, and about the same amount with some overlap for European risks. Last year, we saw new market entrants like Everest and ASQ, and some insurers obtain increased capacity like Ethos and Blue Chip. And we expect this year to be the same. We know Tokyo Marine is looking to come online with the tax team this year. And I think the point separate from reps and warranties insurance is, unlike reps and warranties where the belt is a bit tightening, tax insurance is still very much expanding. And, we're seeing the best rates and market participation yet. As Scott and I alluded to earlier, you're seeing more and more of clients using the insurance rather than as an shoot, more of a corporate risk mitigation strategy or a tax planning strategy. Tax insurance can be used to backstop certain strategies, and the cost right now is so low. The way that I put it is, if you were to be audited on the position that you're taking today and you're uncertain about it, would you pay 2 to 3% of the estimated tax liability as a settlement? Most of the time, the answer is a resounding yes. So I think that's a pretty good reason to go out and get tax insurance. A quick note on the deductibility of premiums. The IRS Office of Chief Counsel issued an internal memorandum in December 2020, which stated essentially that partnerships cannot deduct the cost of tax insurance premium for a partnership's policy related to charitable deductions, and that was because the covered tax position had no relation to the partnership's purported underlying business. We think this is a particularly narrow ruling, as the IRS has also issued rulings and guidance to declare that tax insurance is the preferred method of protecting tax equity investors in those renewable types of transactions, that they don't constitute financial guarantees, and most recently in RevProc 2020-12 for protecting carbon capture credits. And I think the takeaway here is that the deductibility of tax insurance premiums need to be determined on a case-by-case basis, and something to be sure, talked about with your tax advisor. Scott, you got anything for the Biden administration?
Just real quickly, I would say that, given the outcome of the Georgia runoff election and a democratically controlled Senate, then tax changes are likely. I'm not quite sure what that's going to look like. I would say that in terms of changes, so when you had the TCJA in 2017, when you had the CARES Act last year, I thought perhaps we would see kind of more issues pop up that would result in tax insurance. What I think they tend to do, though, is put pressure on traditional issues. So the issues that we see are like restructuring issues or M&A-related issues, compensation issues. What will happen is, for example, if rates go up, say corporate rates go up, or individual rates go up, it's going to put pressure on all those other issues, on NOL issues, on Section 83 comp issues, or 409A issues. So I think that, I'm not sure, it may create novel opportunities or new kind of tax risks that could be insured, and I don't know what those will be, but I do think that it will certainly emphasize the issues that we're already insuring, and that's true for renewables, so that there's a lot of investment tax credits, production tax credits, and like you mentioned, carbon sequestration. Those are going to be certainly emphasized under a new administration. And so where we have insurance for those types of tax risks, I think that's definitely going to be continued under the new administration, if not accelerated.
I think that makes a lot of sense. And last but not least, I know that you mentioned some of the proposed changes, but I think we're also expecting, maybe an increased budget for the IRS, an increased focus on auditing sophisticated taxpayers based on, the kind of economic client and focus we're seeing. The IRS released recently the BBA roadmap for taxpayers, which is a flow chart and tool that, highlights the various stages of the IRS audit conducted now that they're allowed to audit tax partnerships directly. And, after the expiration of what was called the People's First initiative in July, I think the IRS is really starting, they're starting to expect to examine some of these high net worth individuals, and also expected that, the partnerships that they're partners of will be examined as well. So I think, going into 2021, you're going to see a lot of potential changes to the Biden administration's tax plan, but also how they're going after, different taxpayers. You got anything else to add before we flip it over to Jason, Scott?
Real quick, I would say yes. They have started, a campaign to increase partnership audits, and then also a report was recently released by the IRS to Congress reporting on reforms internally, and I think they're creating a new compliance division which is trying to coordinate audits, particularly with an emphasis on high net worth individuals, non-filers, that type of group, to decrease the tax gap. So I would think in the next administration that's probably going to be emphasized extensively.
And I think it makes a lot of sense. I think there's been calls for that for some time. So I think the takeaway there is, for people who are in funds, there might be a little bit of an enhanced spotlight on you, and that makes tax insurance all the more relevant. With that said, I'm now going to turn it over to Jason Goldie, who leads up our litigation insurance department, which is kind of the newest product on the block and is receiving a lot of attention recently. So I'm going to turn it over to Jason now to walk through litigation insurance, what it does and what it can be used for.
Thank you, Austin. Hi, everyone. My name is Jason Goldie, and I'm the business line leader for Alliant Litigation Insurance. And just to jump on what Austin just said, we sort of look at litigation insurance as, if you will, the least mature of our sister products in terms of market familiarity. Tax and obviously reps and warranty is far more widespread. But with that said, the use of litigation insurance, much like tax about 70 years ago, has become increasingly popular. And it's growing in demand, and the market has matured. And so, in a nutshell, litigation insurance insures what we call the unexpected litigation outcome or adverse judgment settlement, and is relevant if you're representing the client as a defendant or a plaintiff. I want to emphasize that it is not just a defense product. It can insure both the plaintiff and the defendant against adverse judgments and or settlements, and that's a critical note to highlight. It also, separately, we offer what's called judgment preservation insurance, which is in the event that your client prevails, whether it's at an arbitration or trial, jury, judge, and has an award or a decision, we can insure against the risk that on appeal, that decision will be reversed or reduced on appeal. So put another way, we can offer an insurance product that essentially secures the entire amount, the monetary amount of that award, which from a carrier perspective is favorable because your client has already prevailed in the underlying proceeding. Those are the main areas. And then finally, I do want to emphasize, and this has become increasingly popular with law firms. Generally speaking, it's the law firm clients that purchase these products, right, because those are the parties in the litigation. But what you've seen now is more and more blue chip law firms taking cases on and agreeing to a contingency billing arrangement. In other words, the law firm underwrites a case itself and decides that they're going to take a reduced fee in return for a success fee in the event the law firm prevails. That's risky for a law firm because if a law firm's got to dedicate 2-3 years of its staff to the case, that's a significant amount of capital that it has to invest. Well, the law firm itself can also purchase an insurance policy. And in the event it doesn't prevail in the litigation, its fees or costs can be insured. And that's become increasingly interesting for a number of law firms that are taking on this work. And so what context do these products play out? Well, first is what I'll call the M&A context, and this sort of piggybacks off of Larry's presentation. Remember, reps and warranty insurance insures against the unknown risk. But by definition, the reps policies do not cover known legal exposures. That's where litigation insurance comes in. If there is a litigation exposure that is obviously specifically excluded from the reps policy, but that is preventing the deal from getting done because the buyer doesn't want to assume the litigation risk and the seller doesn't want to put down an escrow to cover the litigation risk because they obviously have different views on the outcome. Litigation insurance is an attractive solution to that allocation of risk problem, and it ring fences that legal exposure. It transfers it out of the M&A deal to our A-rated carriers, and it enables the M&A deal to get done. The other area, and that's particularly attractive for the M&A private equity partners who have litigation exposures that are impeding the deal. But it also operates outside of the M&A context, and this is a point that I really want to emphasize because I think a lot of sophisticated blue chip litigation partners aren't aware of this. Litigation insurance is prevalent outside of the M&A context. So in what I just call general corporate risk management, standalone. So your client has a litigation exposure. We can offer them litigation insurance to transfer their unexpected or bad outcome exposure to our A-rated carriers. So your client may be able to stomach the probable liability, but it may not want to risk what we call the bad outcome or unexpected liability. And litigation insurance offers an attractive solution to that. And let me sort of highlight the scope of the products in terms of the risks that we can insure. It really runs the gamut. I mean, we've submitted a NAFTA arbitration risk against the state of Mexico. We've submitted a non-compete, non-solicit exposure with respect to a number of employees who wanted to leave their former employer and form a joint venture. We've submitted a mass tort liability. In that case, that was an M&A deal, but the target company was a defendant in a mass tort, and we were able to get a quote on that. And we are in the process of hopefully binding a breach of contract involving iCloud software in the M&A context. So it really runs, and then finally, I should add finally, with judgment preservation insurance, there was a significant jury award earlier this year, and the insured wanted us to explore securing a tower approaching $1 billion to hedge against the risk that the patent award, which was in a jury trial, would be reversed or reduced on appeal. So I wanted to secure as much as possible, and we thought we could build a $1 billion tower. That's probably the capacity that we could build, but we thought we could do it. And so you're talking about risks from patent, intellectual property, NAFTA arbitration risks administered by the World Bank, employer liability, mass tort, breach of contract. It really runs the gamut, and as I advise all our clients and law firms, if we have a submission, a robust submission that clearly defines the liability and can quantify it, and we can characterize it as unlikely or remote, it is a good candidate for litigation insurance. Let me finally describe the time frame for which these policies can get done. It does take longer than I would say the traditional tax or reps and warranty policy. It takes about a week to get a quote. So I think in that sense, it's pretty stereotypical. But the due diligence period for the litigation carriers just takes longer, the confirmatory due diligence. So I would advise that if particularly with an M&A deal where there are timelines, you really should think about this as 6 weeks from start to finish, I think or to 2 months, but I think less, maybe 6 weeks would be sort of a good time frame to assign if there were deadlines that you wanted to meet. So with that said, if you have any questions, I'm happy to answer them, and I appreciate everyone listening.
All right. Well, thank you very much, Jason. And we'll proceed with questions. I know that we don't have much time left, but if you have any questions, please feel free to ask them now, and we'll give you our best shot at an answer. If we don't have an answer for you, we'll follow up offline. But thank you very much for everyone for joining the presentation today, and looking forward to speaking with you soon.